Hello everyone, welcome to this teaching. In this video, we're going to be talking about two things, anatomy of a candlestick and market structure. So the video is going to be divided into two segments. And if you already know about the anatomy of candlestick, you can just go right ahead and skip to the market structure part. So first things first, there are two types of candlesticks. And the reason why everybody needs to understand candlesticks is because it's essentially the building block of any chart you will see out there. So every single one of these things you see over here is called a candle, right? And we have two types of candles. We have a bullish candle and a bearish candle. Now, a bullish candle, this is a candle for in simple terms, it's a candle that closes at a price that is higher than its opening price. So assuming it opens at the price of, let's say, 500, it closes at the price that is higher than 500. So let's say 1000. That's a bullish candle. Whereas a bearish candle is one that closes at a price that is lower than its opening prices. So if it opens at, let's say, 500, instead of closing higher than 500 in the case of bullish candle, in the case of bearish candle, it's going to close lower than 500, say 480, 400, however the case may be. So bullish simply means closes higher, bearish means it closes lower. So I have a representation over here. Now, as you can see, like I said, in the case of a bullish candle that we have over here, the closing price is higher than its opening price. So let's say the candle opens somewhere over here, right? It goes up. If it opens at 500, it goes up and closes at the price of, let's say, 550, 600, 650, whatever price it is, as long as the price is higher than 500, its opening price. Whereas a bearish candle is a candle that closes lower than its opening price. So if this is 600 per se, it goes and closes at around 500, 480, whatsoever the case may be, as long as the closing price is below or lower than the opening price. Now, other parts of a candlestick that we have include the wick. So let me type that in here. So a wick is this part essentially that isn't made up of a candle, that is just like a line. So whether for bullish or bearish, right? So these are all wicks. Now, what forms the wick? Now, when this candle opens at around, let's say, 500, it doesn't just go from opening price and then closes, yeah? So after opening, there's a price that it reaches. Let's say it opens 500 and it reaches an all-time high of 700, right? But before closing, it comes back to this price. So that means this candlestick, in the duration of time it represents, it went from an opening price of 500, reached an all-time high price of 700, but closed at, let's say, 650. So this simply indicates the highest price that this candle went to. In the same manner, the low price over here represents the lowest price this candle went to after opening. So if this was 500, the opening price, perhaps the lowest price it went to was 480, right? Before then going up to give us an all-time high of 700 and then coming to close at, say, 680. That's why every candlestick is made up of a opening price, a closing price, a high price, and a low price. In the same manner for a bearish candlestick. So the only difference between a bullish candlestick and a bearish candlestick is that the opening price and closing price differ. In the case of a bullish candle, the closing price is higher than the opening price, and in the case of a bearish candle, the closing price is lower than the opening price. Now I've created this image so that you can be able to screenshot it perhaps to remember easily. So this is a bullish candlestick, this is a bearish candlestick. Now the color is actually not that important because it's not on all charts that you would see a bullish candle represented by the color green or a bearish candle represented by the color red, right? Because you can easily change your colors on TradingView. So to be able to identify bullish and bearish candlestick on the chart, you can simply choose the colors, or even here over here you have your OHLC values. That simply represents your opening price, your high price, your low price, and your closing price. So say we come to this candle, for example, this green candle, you can see that the opening price says 2896.66 and the closing price says 2898.055. That shows you that the closing price is higher than the opening price, right? And if you come to this bearish candle over here, you see the opening price is 2898, whereas the closing price is 2897. So that's lower, right? Okay, so now we're going to be jumping into the segment on market structure. Now, for the sake of introduction, I want you guys to understand that in the industry, in the trading industry, when prices keep increasing, that means we are in an uptrend, right? So prices are increasing, we are in an uptrend. So the terminology we use is that we are bullish. Like in the case of the candlestick, a bullish candlestick is one that closes higher, right, than its opening price. So when prices keep increasing, we say we are bullish or in an uptrend. Whereas when prices keep decreasing, we say we are in a downtrend. So that means we are bearish, which is represented by these figures over here. Now, the good news is that as traders, we are traders, not investors. It's only when you are an investor that you need prices to go up to make money. Because say you buy a gold bar at the price of $2,000. Now, for you to make money off of that gold bar, you expect the price to go to something like 2,500, 3,000 per gold bar. Then you'll be able to capitalize and make a profit of 500 or 1,000 as the case may be. But because you're a trader and not an investor, you don't really need the prices of an asset to go up to make money. So these prices can go down and you can still be making money because you can simply decide to be selling instead of buying, right? So when prices are increasing, you want to be buying or going long. When prices are decreasing, you want to be selling or shorting. Now, market structure. Market structure is the current state of a market, including its behavior, condition, and flow. It helps traders understand the market's bias and predict price trends. Now, this simply means that to every market, right, there are certain characteristics you want to understand in order to be able to tell whether we are bullish, that means going up, or bearish, going down. So when prices are going up, you need to have certain characteristics that will be able to tell you, yes, we are bullish. The same way when we're bearish, there are certain characteristics that you need to be there to tell you that, yes, we are bearish. So types of market structure. Now, we have a bullish market structure, a bearish market structure, and a ranging market structure. For the bullish and bearish, we classify them as trending market structure, right? Because it's either trending bullishly or trending bearishly. That's either an uptrend or a downtrend. Whereas for a ranging market structure, it's the opposite of them. So, first of all, for the bullish market structure, this is when the market is trending upwards. This is characterized by higher highs and higher lows. We already established earlier that a bullish market structure is when the market is going upwards, right? Whereas bearish is when the market is going downwards. So, for us to be able to classify a bullish market structure, this is when prices keep forming higher highs and higher lows. So, I like to give this example whenever we take, which is that let's say the price of a bag of rice is 20,000. Let's say last month it was 20,000, and so at the beginning of this month it went to 40,000. Then we had a pullback and price now returned back to something like, let's say, 30,000, and from 30,000 it goes to 50,000. Now you notice that that new low it formed of 30,000 wasn't lower than the previous low of 20,000. So you can't really say that the prices of a bag of rice is dropping, because the new low it formed was 30,000, which was higher than the normal low we know. So this new low of 30,000 is now essentially a higher low, right? So in a bullish market structure, it is characterized by higher highs and higher lows. So the bag of rice keeps going from 20,000 to 40,000 to 60,000. And then whenever the price is reduced, it doesn't really reduce to the point of the original price we know, right? So 20,000 to 40,000, it now pulls back to something like 30,000, but it never goes back to 20,000. From 30,000, it goes to 40,000, pulls back to, let's see, you understand? So bullish market structure is characterized by higher highs and higher lows. Let me give this example over here. This is when the market is trending upwards and is characterized by higher highs and higher lows. So as you can see over here, this is a higher high. So let's say this is okay. Let's say this low over here was the price of 20,000 for a bag of rice, and then this high was 40,000. Now, towards the middle of the month, let's say something happened that made the bag of rice return to somewhere around 30,000 per bag of rice, right? And then we now continued higher. Now, despite the fact that the price of a bag of rice reduced, we never actually went back to the original point of what? 20,000, right? So because we did not go back to that original low of 20,000, but instead form a new low before forming a new high, and this new low happens to be higher than the previous low, we call this a higher low. So after now retreating to something like, let's say, 30,000, price now continued on, and the bag of rice now became 50,000. So this was 20, this was 40, this was what? 30. And now we're at 50. So now when the prices of this bag of rice reduces, let's say to 45,000, and then continues going higher, you see that we keep having a low, but we never actually go back to the original price. We actually never go back to the original low price, right? So a bullish market structure is characterized by higher highs and higher lows. So in the case of a bearish market structure, this is when the market is trending downwards and is characterized by lower highs and lower lows. So instead of the market going upwards, forming higher highs and higher lows, in this case, we keep having lows that are lower than the previous lows and highs that are lower than the previous highs, right? So it's a lower low, it's a lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Hope that makes sense. So this is what a bullish market structure looks like. We said in a bullish market structure, we want to see a higher low, a higher high, followed by a higher low, higher high, as the case may be. And in a bearish market structure, we want to see lower highs, lower low, lower highs, lower low, lower highs, lower low, right? Now, for a ranging market structure, this is when the market prices are consolidating within a range and never truly forming a bullish or bearish structure. We mentioned that for a bullish market structure, we want to see higher highs and higher lows. And for a bearish market structure, we want to see lower lows and lower highs. But when price is not visibly forming any higher high, higher low, or lower highs and lower low, then we can now classify that as a ranging market structure, right? Because the market is not trending upwards, nor is it trending downwards, right? So that is a ranging market. So now I want to show you a classic example of a bullish market structure, right? So we said that in a bullish market structure, we want to be characterized by higher highs and higher lows, right? So let's begin from this point. Now this is a low. Let's establish this as our original low and this as original high. Now we said in a bullish market structure, price should what? Always keep forming higher highs and higher lows, right? So if this was the original low, that means the next low should not be lower than this initial low, right? So we see this is a higher low. Now we want to make sure that the next high price is higher than this, right? So over here we have our new higher high. For the next low, we want to ensure it's not lower than the previous low. So over here we have a what? Higher low. Next high, higher high, right? Higher low, higher high, higher low, right? As the case may be. Higher high. We do see this pullback over here, right? Now go on to keep forming higher high. Now, of course, there are cases whereby price will come below this higher low, but that's for the purpose of liquidity grabs and all that, which will be taught to you later on. So this is essentially the characteristics of a bullish market structure. So we keep forming higher highs and higher low, right? So higher high, higher low, and so it continues, right? Higher highs, higher low. So now we wait for another higher high, right? Unless we now break structure below this low. Now for the bearish example, we start from over here. So this is a high. We now have a lower low, a lower high, lower low, lower high, lower low, lower high, lower low. So now how we would confirm this lower high over here is when we form a new lower low below this low at this point. So the moment we have a body close below this low, then we can confirm that yes, we have a new lower low, and so this is our lower high. And we don't expect price, if it's actually in a bearish market structure, to go close above this. Now, what you want to understand about market structure is that the time frame plays a very vital role, because the lower time frame market structure is capable of changing easily, whereas the higher time frame market structure is the one that shows you the overall direction of the asset you're on, right? So right now we are on GBP JPY on the 1 hour time frame. If you go to the daily time frame, you will see that that portion of bearish market structure was just, a very minute portion of what was actually happening. So on the daily time frame, if we were to mark out our bearish market structure, right? So from this high, you can see this was our lower low. Then we had a lower high, right? So as of this point, we cannot see, as of this point, we cannot see this is our new lower low. So as of this point, we have a new lower low. So this is our lower high, right? So as long as price has not gone and broken structure above this high, we can't say that we've shifted structure, right? Now I want to show you guys how to identify a valid break of structure, right? So when you are, say, in an uptrend, for example, you know that we want to see formation of higher highs and higher lows. So now the thing is that we do not have a valid break of structure if it has just wicked through the previous higher high. So we cannot call this a valid higher high, because what just happened here is that we wicked through the previous high. Because we talked about how part of a candlestick is that it has a wick and a body, right? So in order for us to characterize something as a valid break of structure, the body of the candle must break above the previous high. So over here, you can see the body of the candle broke and closed above this previous high. So we can now say that yes, this is a valid break of structure because the body of the candle closed above this previous high. But at this point, what just happened was that we wicked through it. So it's only the body that was there. So it's not a valid break of structure. So let me find a chart example. So see this example, you can see that over here we were in a kind of an uptrend. And so if you had used this week as your break of structure and characterize this as a new higher high, see what will have happened. Price sold off. But because we know that this is not a valid break of structure, then we have not yet formed a new higher high. So as of this point, this is not a valid break of structure. A valid break of structure is when body, so like over here, for example, this week, when this body closed above it, that's a valid break of structure, right? While for a downtrend, you can see this week, when the body closed below it, let me zoom in. So you can see the body of this candle. Let me come over here. Okay, good. So you see at this point it was just a week. But at what point did we have a valid break of structure? That was when this candle closed below this low, right? So that's how to characterize a valid break of structure. Over here you can see another, this low. So it's at this point, right on this candle, that we had a valid break of structure. Over here, same thing. So on this candle we had the valid break of structure. Right, break of structure. So you can now characterize these as what? Lower highs, lower low, lower high, lower low, lower high, right? Lower low. So that's how it is. I hope this video was insightful. If you have any questions, please leave it in the comment below and we'll be sure to get back to you. Cheers and God bless.